Initial January data is signaling below average global economic growth in 2025. What are we learning from the slew of data coming in, and giving a first glimpse on how the year is starting and what lies ahead? For the first time in more than 2 years, we saw US manufacturing growing amid strong orders, even as cost of raw materials are likely to be affected by higher tariffs and price hikes are imminent. The Institute for Supply Management, as the ISM manufacturing PMI, increased to 50.9 last month from 49.2 in December in the US. That was also stronger than expected, but still not very robust. Hello, this is Bode Oshosami on Global Business Insights, where we bring ideas and discussions on the business headlines. In the US, there is optimism with many question marks. Indeed, manufacturers say there is less political uncertainty, and the pro-business stance of the new administration is positive for them. Production has already improved, and factories have also stepped up their hiring to meet planned growth of production capacity. The news that Trump tariffs on Mexico have been paused for a month as the president of Mexico, Claudia Sheinbaum Pardo, announced deployment of troops to the border must be reassuring. But investors still risk off with gold prices and the dollar appreciating as the situation remains unclear. But there was some good news yesterday night. Trump also delayed tariffs on Canada for a month, even as Justin Trudeau in his tweet says he's implementing a $1.3 billion border plan, reinforcing the border with new choppers, technology and personnel, as well as enhanced coordination with American partners, plus increased resources to stop the flow of fentanyl. China, in a swift retaliation to US tariffs, has hit a range of American goods, including a 15% levy on liquefied natural gas and coal. Agricultural machinery, crude oil, large displacement cars and pickup trucks will also now face a 10% tariff. China is also targeting US brands like Google, Calvin Klein, Tommy Hilfiger and others for more measures. Trump is expected to speak with China's Xi Jinping soon with hopes of a deal to resolve the issues. In Europe, the Harmonized Index of Consumer Prices, HICP, was up year-on-year 2.5% in January, above the target of 2%, and it came after increasing 2.4% in December. On a monthly basis, the bloc's HICP declined 0.3% in January compared to December's 0.4%. The Eurozone's struggling factory activity signaled early signs of stabilization. At the start of the year, we saw resilience to still rising costs and to the imminent threat of US tariffs, with a much more positive outlook. According to the latest survey, the final Eurozone Manufacturing Purchasing Managers Index was up to 46.6 in January, ahead of estimates for 46.1. The Eurozone is doing better, but still not good enough. In the UK, manufacturing activity in January lingered in contraction territory. Weak demand and lackluster business and consumer confidence were the main factors underlying the latest scaling back, and also centered on the consumer goods industry, where the rate of decline accelerated to its sharpest since December 2023. For the Chancellor of the Exchequer, it's all about growth in her speeches, but fiscal room is tight for any major incentives to the private sector, and the pressure is to cut public sector spending, which may also hurt economic activity. UK can't seem to escape the gravity of tepidity, holding back any economic breakthrough. In India, where January PMI was up to 57.7 from a one-year low of 56.4 in December, the January data is marking a 6-month high, as domestic and export demand were both strong, supporting new orders growth. while in China, expansion also dropped to 50.1 from 50.5 in the latest manufacturing Caixin PMI data. China still has capacity, though, to release more fiscal support to get better growth as it focuses on boosting domestic consumption in a tougher external context. But let's close on Nigeria, where PMI was in expansion in January, albeit down from 52.7 in December to 52.0 in January. The survey says growth is likely to pick up across manufacturing and trade, while ICT and finance and insurance should continue to play a big role in economic performance, while agriculture will likely still lag its long-term average given lingering internal security challenges, high input costs and extreme weather conditions. As we expect, rebased GDP data, high inflation and exorbitant costs of borrowing set to hold back any significant economic growth. Stanbic IBTC research say they see headline inflation averaging 30.5% year-on-year in 2025 and ending the year at 27.1% year-on-year. The government is targeting an optimistic 15%. Still on Nigeria, early this year we spoke to Mr. Anthony Osibodu, who directs an extensive international logistics operation, on what needs to change to improve the volume of trade both on the domestic and international front. There are no shortcuts, like the Minister of Trade and Investment, Dr. Jumoke Oduwole, recently said, and the problems will not fade away without intentional and robust actions. Mr. Antonio Osibodu, based in the UK, is a seasoned professional who has traversed various sectors from civil engineering to IT before settling in the logistics sector, and he has spent over 25 years in the logistics industry.
Recent government policies aimed at stabilizing the exchange rates are creating a more predictable environment for exporters and manufacturers. A stable currency reduces uncertainty in pricing and helps manufacturers plan better, particularly those sourcing raw materials or targeting international markets. Additionally, with the new refineries coming online, Nigeria is reducing its dependence on imported fuel. That not only addresses the foreign exchange pressures, but also creates room for local industries to thrive by redirecting resources to productive sectors like manufacturing and exports. However, to capitalize on this momentum, we must tackle structural issues such as inadequate infrastructure and high production costs. If the government and private sectors can work together to improve transport, energy, and access to credit, Nigeria will be well positioned to expand its manufacturing base and leverage its export potential. Poor road conditions cause delays and inflate logistics costs. On top of that, our extensive waterways, which should be a major advantage, remain underutilized due to insufficient investments and poor port facilities. This combination drives up costs and reduces competitiveness for Nigerian goods both locally and internationally. I've seen a remarkable uptick in sectors that were previously dormant. Planes leaving Nigeria, which used to fly out empty, are now filled with exports like foodstuffs and Asoebi fabrics. Unfortunately, most of this trade is informal because the formal processes are too complicated and burdensome. The truth is Nigerians are rule followers by nature, but the excessive paperwork, delays and roadblocks in our systems often force people to resort to informal channels to get things done. While these shortcuts ensure survival, they deprive the government of critical taxes and economy of much needed revenues. For example, minerals are being exported on significant scale, but weak regulation means that much of this goes unrecorded and untaxed, which limits the benefits to the nation. As Africa's largest population and one of the most significant economies, we are an attractive partners. By leveraging our size and economic potential, we can position ourselves strategically to negotiate favorable trade terms with the US without having to act as a part of a bloc. To fully realize these opportunities, however, we must address the systemic challenges in our trade and logistics system. The ease of doing business in Nigeria depends largely on what you are comparing it with. Compared to smaller African countries, Nigeria offers a much larger market, more resources, and greater opportunities. However, when compared to more developed economies or even other major African economies like South Africa or Egypt, Nigeria lags behind. On the positive side, Nigeria has a strategic location, making it a central trade hub for West Africa. With a population of 200 million, the market demand for both imported goods and exports such as crude oil, agricultural products and minerals is substantial. Additionally, the government's push for economic diversification, including initiatives like the Zero Oil Plan, has opened up new opportunities in non-oil exports, which has become even more competitive thanks to the depreciation of the naira. That said, significant challenges remain. One of the biggest hurdles is Nigeria's complex regulatory environment. Multiple agencies such as Customs, SON, and NAFDAC are involved in the import and export processes, and they always coordinate ineffectively. This leads to delays and increased costs. Infrastructure also remains a major issue. Poor road networks and congested ports like Apapa and Tinkan and unreliable power supply add significant costs and delays to the logistics processes. I'm going to make particular mention of the PROMEM system as an example of one of those complicated processes that hinder business. This system, which was designed to monitor foreign exchange usage and ensure trade compliance, overlaps with other requirements like the pre-arrival assessment reports, which is the PAR, making the process even more complicated and time-consuming than necessary. This redundancy adds to the cost of doing business and hampers Nigeria's competitiveness on the global stage. To summarize, while Nigeria has a strategic advantage due to the location and market size, the operational challenges like the regulatory inefficiencies, infrastructure gaps, and reduced processes still pose significant obstacles. If we were to simplify trade processes, enforce compliance more effectively, and invest in better infrastructure, Nigeria would unlock full potential and become a far more attractive destination for businesses and formal trade.
To other business news, US stocks recovered a bit after the US and Mexico said tariffs against the trading partner will be on hold for 1 month. Stocks initially dropped after Trump hit several countries with tariffs over the weekend, stoking concerns of a trade war and disruptions in global supply chains, which of course could ignite inflation. US stock futures were positive earlier today following the pausing of US tariffs against Canada. Investors are also optimistic that the upcoming call between President Trump and President Xi could lead to negotiations similar to those with the leaders of Mexico and Canada. Federal Reserve Bank of Boston President Susan Collins reiterated yesterday that there is no urgency for the central bank to lower rates right now, also with the possibility that new tariffs could drive up inflation. She added that one would expect the kind of broad-based tariffs that were announced over the weekend to have an impact on prices, although it's unclear how much and how the central bank would need to respond. The White House said in a statement late yesterday that Trump signed an executive order to begin developing a U.S. government-owned investment fund. TikTok was cited as an example of a potential asset for the new sovereign wealth fund. And in South Africa, Mineral and Petroleum Resources Minister Gwede Mantashe has scoffed at US President Donald Trump's threat that the world's largest economy will withdraw aid to the SA economy, saying that South Africa could equally deny US access to its wealth of minerals. Trump had signed an executive order last week suspending foreign aid for 90 days, including funding support to Africa. He also criticized South Africa's land reform policy, initially sending the rand plummeting. Asia-Pacific markets were mostly higher after Trump paused tariffs on Mexico for a month, even as Canada also said the US president had put proposed tariffs on its exports on hold. Well, that's it on this episode of Global Business Insights. We again remind you that you can watch us on Business Day TV YouTube channel Monday to Friday at 11 a.m. West Africa time. Thanks for watching. This is Bode Oshosami. Bye-bye.